Welcome to Paisa Forever channel, everyone. Today we are exploring a seismic shift in the Indian financial markets that has defined the first half of 2025. If you have been following the news, you've likely heard about the incredible performance of defense-oriented mutual funds and ETFs. In May 2025 alone, we saw a surge in returns ranging from 13.67% to a staggering 18.75%. To help us navigate this post-Operation Sindoor wave and understand if this is a long-term strategic opportunity or a short-term spike, I'm joined by a specialist in thematic investing. Let's start with the immediate numbers because they are hard to ignore. What exactly happened in May 2025 to trigger this?
It has been a historic period for the sector. While the broader equity markets remained relatively flat or only moderately positive, the defense sector broke away from the pack. The primary driver was a combination of heightened geopolitical activities, specifically the impact of Operation Sindoor and ongoing border tensions, which forced a renewed market focus on national security. This was further amplified by fresh government spending cues that revitalized investor confidence after a bit of a volatile period between late 2024 and early 2025. The Nifty India Defence Index actually reached a record peak of 8,309.15 in mid-May 2025, surging 5.5% in a single Friday session, while the Nifty 50 actually dipped slightly.
That's a massive decoupling from the broader market. But for those of us looking at the long-term horizon, this seems to be part of a much larger policy framework. We keep hearing about Atmanirbhar Bharat and Make in India. How deep do these roots go?
These initiatives are the true engine behind the growth. India has pivoted from being one of the world's largest importers to a serious global producer. For the financial year 2023-24, India's defense exports hit a record 21,000 crore rupees. The government has set incredibly ambitious targets for the near future, aiming for 3 lakh crore rupees in total production and 50,000 crore rupees in exports by 2029. To support this, the 2025-26 Union Budget increased defense spending by 9.53%, bringing the total allocation to 6.81 lakh crore rupees. This isn't just a trend, it's a structural transformation supported by the positive indigenization list, which now includes over 500 items that the military is mandated to buy only from domestic companies.
So the government is essentially guaranteeing a market for these local firms. If an investor wanted to get exposure to this growth through mutual funds or ETFs in mid-2025, what were the standout performers?
As of late May 2025, the leaderboard was dominated by passive index funds and ETFs. The Motilal Oswal Nifty India Defence Index Fund and the Aditya Birla Sun Life Nifty India Defence Index Fund both posted one-month returns of approximately 26.11% and 26.10% respectively. Close behind was the Grow Nifty India Defence ETF Fund of Funds, which delivered a 25.85% return in the same period. If we look back further into the 2025 data, the Motilal Oswal Nifty India Defence ETF actually delivered an absolute return of 41.15% over a 6-month period ending in August 2025.
Those 6-month returns are almost unheard of in traditional sectors. Can you give us a concrete example of what a one-time investment would look like during this rally?
Certainly. Based on data from July 2025, if you had invested 1 lakh rupees into the Motilal Oswal Nifty India Defence Index Fund just 3 months prior, your investment would have grown to 1,36,941 rupees. A similar investment in the Aditya Birla Sun Life Fund would have been worth 1,36,869 rupees, and the Grow ETF Fund of Funds would have turned that lakh into 1,36,717 rupees. Even the HDFC Defence Fund, which is actively managed, would have turned that 1 lakh rupees into 1,29,483 rupees over that same 90-day window.
You mentioned HDFC being actively managed. That sounds like a different beast compared to the index funds. What should investors know about the difference?
It is a very distinct approach. The HDFC Defence Fund is currently the only major actively managed fund in this space. While the index funds simply track the Nifty India Defence Index, HDFC's fund manager actively picks stocks and adjusts the weightings. This shows in their portfolio. As of April 2025, HDFC held 22 stocks with a massive assets under management of over 7,400 crore rupees. In April alone, they were very aggressive, increasing their stakes in companies like Hindustan Aeronautics Limited, HAL, BEML, Astra Microwave Products, and Solar Industries.
Does that active management come with a higher cost for the investor?
It does. The expense ratio for the HDFC Defence Fund is roughly 0.72 to 0.78%. Compare that to the Grow Nifty India Defence ETF Fund of Funds, which has a much lower expense ratio of 0.21%. The Motilal Oswal and Aditya Birla Index Funds sit in the middle, around 0.31 to 0.44%. When you choose active management, you're essentially paying more in the hope that the fund manager's stock-picking skills can outperform the simple index. Though in the May 2025 spike, the passive index funds actually had the edge in terms of raw percentage gains.
Let's talk about the companies inside these funds. We keep hearing about the Big Four or the Big Five. Who are the heavy lifters of the Indian defense sector?
The titans of the industry are companies like Hindustan Aeronautics Limited, HAL, which is the leader in aircraft and helicopter manufacturing. HAL recently secured a massive deal worth 62,000 crore rupees to produce 97 Tejas Mk-1A fighter jets for the Air Force. Then there is Bharat Electronics Limited, which is the king of defense electronics, supplying radars, missile systems, and communication gear. Mazagon Dock Shipbuilders is the premier name for naval warfare, building submarines and warships, and Bharat Dynamics is the primary producer of guided missile systems. These companies often represent the largest chunks of the funds. For example, in the Motilal Oswal ETF, HAL and BEL together make up over 42% of the total holdings.
That sounds like a lot of eggs in just a few baskets. Does that concentration pose a risk?
Absolutely, and it's something every investor must consider. These funds are classified in the very high-risk category. Because they are thematic, they lack the diversification of a multi-cap fund. You're exposed to sectoral concentration risk. If the government decides to cut the defense budget, or if a major project like the Tejas production faces a delay, the entire fund could take a hit. There's also geopolitical risk. While border tensions often drive spending, sudden shifts in international relations or changes in government procurement policies can cause high volatility. We saw this early in 2025, when the sector went through a correction after peaking in late 2024.
Beyond the risks of the stocks themselves, are there technical factors like exit loads that investors should be looking at?
Definitely. Exit loads are fees you pay for leaving the fund too early, and they vary significantly. The Motilal Oswal fund, for instance, has a 1% exit load if you redeem within 15 days. The Grow ETF fund of funds has a 1% exit load if you redeem within 30 days. However, the Aditya Birla fund is much more lenient, with an exit load of just 0.05% if you redeem within 30 days. This is why it's important to match the fund to your intended investment time frame.
For someone who is looking to start small, perhaps a beginner, is there a minimum entry point?
Most of these funds are very accessible. You can start a systematic investment plan or SIP with as little as Rs 500 per month in the Motilal Oswal, Aditya Birla or Grow funds. SIPs are often recommended for such a volatile sector because they allow you to average out your purchase price over time, reducing the risk of a poorly timed lump sum investment.
It's also worth noting that some of these funds are framed not just as financial instruments, but as a way to align with national goals.
That is a unique psychological factor here. Many retail investors feel that by investing in these ETFs, they are contributing to the nation's strategic and economic development. It's a sense of pride in supporting the Atmanirbhar Bharat mission. Of course, from a purely financial standpoint, these companies are attractive because they often have stable long-term government contracts which can provide steady revenue even during broader economic downturns.
To wrap things up, Speaker 2, what should be the final checklist for someone looking at the 2025 defense boom?
First, analyze the fund's expense ratio and tracking error. You want your money going into the market, not just into management fees. Second, check the AUM. A larger fund like HDFC at 7,400 crore or Motilal Oswal at over 3,800 crore generally offers better liquidity. Third, be mindful of the geopolitical landscape. The sector is highly sensitive to news. And finally, remember that the 2025 surge has been remarkable, but past performance is never a guarantee of future returns.
This has been an incredibly detailed breakdown. It's clear that the defense sector is no longer just for institutional players, it's become a focal point for the modern Indian retail investor. Thank you for your insights.
My pleasure. Always remember to do your own due diligence before making a move in such a high-stakes arena.
Well said. For those of you listening, keep an eye on the budget cues and project milestones, and we'll see you in the next deep dive.